Hi, this is Richard Campo from Rose Capital Partners. I'm just putting this video together to talk through the things you need to think about if you are a limited company director and you're looking to get a mortgage. Many people don't realise that if you're a company director, different rules can apply when you're looking to get a mortgage. So in this video, I'm just going to talk through when those rules change and who they apply to, what the pros and cons are, then ultimately what we need to look for in a bank in how we get the loan approved for you. Just for clarity also, this is purely for a property you're looking to move into or you're looking to refinance. If you're looking to buy an investment property through a limited company, that's no problem. That's called limited company buy-to-let, and there's other resources on our website that you can look to for that one. So in relation to purely moving into a property then, so if you are a limited company, when do the rules change? This is purely around the level of equity you may or may not have in the company itself. So the dividing line is around 25% of the shares of the business. So if you own more than 25% of the shares in a business, you'll often be treated as self-employed. If it's less than 25%, you'll be treated as a normal employee. Now this is very, very key difference because if you are, say, you own less than 25%, you'd be treated in a pretty much normal way and there shouldn't be any additional work that needs to go into it. If you do own more than 25%, the way that banks view it is that you have a large level of influence on the business, and therefore the company performance is just as important as your income because that's how viable it will be going forward. I appreciate from a tax point of view you are an employee, maybe your only source of income. That's where things like your tax position and mortgage assessments are very different, and that's why it differs. Now, to look at sort of the main upsides and downsides of this approach, probably the sort of key things around being the downside are, one, the company performance will be a big factor. And certainly post-COVID, there's lots of things where businesses have taken CBILS loans, bounce back loans, or taken some grants. Now, none of those things are a problem, but where banks get nervous is that may mask the impact of the business itself. So what banks do at the moment is look in quite a lot of granular detail is, were any of these forms of assistance taken? If they are, how's that going to affect the business going forward? So if we can put a logical argument together and we can evidence actually it's not a major factor, it's all taken care of, then fine. If it isn't, then it could have an adverse impact on the application itself. The other sort of real downside is if the company has made a loss in the last 3 years, but certainly in the last year or two, it can become a very large factor. Now, based on what I said before, banks are trying to be more pragmatic and they will try and work with you on this, but it can become much more difficult. Now, if there's an explainable event, we can sort of get around it potentially that way, but just bear in mind that if there is a loss specifically in the last 2 years, most of the high street banks may not play ball on a mortgage. There are other specialist providers we can talk to, but that really is sort of the really, really major downside of this. The last one is really that it becomes very sector specific. So let's take a sort of easy example. Let's say you are a director of a company that does sports hospitality. Now, banks are going to look at this in great detail, as they will in any aspect of the economy which they deem could have been adversely affected by COVID. Now, what we could do is go to a bank and say, well, actually, yes, that was your business model. However, you've moved to a more online approach, you've cut your overheads, and these are the things you've done. A bank may well be willing to lend you a mortgage, so it may not be a big impact. If it's more a case that all the company's on furlough and there's been taken lots of grants to keep things forward and the company's purely in a holding pattern until the economy opens up again, that might be harder work. Not to say it's impossible, but that's sort of the key defining sort of, or really the explanations we need to give as to why it's viable, why it's not, what the pros and cons are. So we do need to get in a lot of granular detail in this area, so please be aware of that. Now, it's your business, you're going to know this stuff. And this is why working with a broker is so key, because we can draw this information out and present it to a bank. Presentation is absolutely everything. That's the difference between just throwing information to a bank and getting declined, or providing information but with an explanation and making it all very logical. So I don't want to labour the point, but that's something we really do have to work on. And that's really where a broker is very good, because we don't have to go to one bank, we've got the whole market to aim for. So we can package things up in a nice way and say, right, this is the right bank for you and let's go there. And that make the whole thing run a lot smoother. So they're the downsides, but there are upsides too. Being a company director, typically you have a larger or more complex income. And for that reason, banks are quite happy to work with you. Again, sort of this is where something like private banking comes into play, because very specifically, if you earn over £300,000 a year, you are deemed a high net worth individual, in which case then affordability rules don't apply in the same way. And some of those challenges I've just mentioned, banks can look past that if there's a wider play there. Why private banks like company directors is that you may well experience what's called a liquidity event further down the line, or what I call getting a load of cash. That might be where someone buys you out of the business, you float, you sell. And that's why private banks love these sorts of clients, because that's far more of a possibility for you than most other people. And then when they're really happy to work with you, they might want to reinvest that money or fund a venture going forward. That's what private banks are brilliant at. So it's all about picking the right horse for the right course. So looking a bit more specifically then, is what types of income are acceptable. So most of the things you'd expect, your basic salary, any bonus or commission, but also you can factor in things like dividends and also company profits. And if you're a part of an LLP, it could be your profit share and your drawings. So again, a bit more complicated in that sense, but some or all of those things could be taken into consideration. This is where getting down to, again, granular detail again is really useful. What banks love in this area is something called your SA 302, and that's HMRC's confirmation of the tax you've paid. And if you've ever seen this document, it really neatly lays out your income, sort of salary, dividends, etc., any property income, all that stuff. It's all there, neat and tidy. Now, if we can get that together, great. That means we can go to pretty much all the high street lenders. If we can't get that together, then what we might want to look at is the company accounts, or if we don't want to do that, or it's preferable, we can always go to your accountant for a reference as well, or your finance director. So they're the sorts of avenues we can go down. And this is really getting into the weeds of, okay, what assessment is needed, what documentation is required, and therefore what bank do we approach. So going back to my point mentioned on the downsides, there is more work to do, there's no getting away from that. But any good broker will very early on ask for these documents. We can do a lot of the work ourselves now, because again, one of the real positives to come out of COVID in our world anyway, is banks are more open to work with brokers than they ever have been before. They've been very limited on resources, so what they've done is open up their underwriting, their credit policy, or their affordability tools, because they want neatly packaged cases from us, because we can put it together, send it on to the bank, and it gets assessed a lot quicker. That lessens their resources needed and improves the outcomes. So these one actually, perversely, one of the real good upsides is that we can get the information, package it correctly, and everything goes smoothly. Conversely, if you don't do this, or potentially if you think, well, I'm just not going to mention the fact I own like 27% of my business, it will come out, because banks do companies' house checks. They'll look at other ways of looking at like a tax return. So if you're submitting a tax return and you're just an employee, there's obvious ways around it. So very rarely does that happen, but just to make the point that the more open and honest you can work with a broker, the better the outcome. It's really simple as that. So that's sort of really the main points to think about. I've touched on this sort of fairly quickly, and as you appreciate, there's quite a lot of detail. I know I've just sort of given you one silly example there, but it's a big wide economy with very different factors in it. So if you do fall into this category, I would really urge you to talk to one of the team. We can very quickly ascertain where you're at with this, get the documents required, give you some good advice, and ultimately, and this is the point, make your life easy. If you're in this position, you're busy, you got a lot of stuff going on, you don't need the hassle of a mortgage application taking over your life for the next few months. We take the burden on, and we want to make your life easy. So if that sounds good, please do get in contact, and one of the team would love to help you.